mode.
Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending October 22nd, 2021. I'm Preston Brent. Thanks for tuning in, everybody. Well, this week's theme is even dinosaurs were transitory, and I guess transitory depends on the time frame, doesn't it? Dinosaurs roamed the earth for quite some time before they were destroyed, so I'm assuming inflation's going to hang around for a bit, a little bit longer than people think. So be that as it may, why don't we go in and let's take a look at where we were and where we're going. So looking at the market, and let's take a look at the index performance right now, you can see that we finished another strong week, and the Dow and the S&P both making new all-time highs. And we've got strong investor sentiment. The VIX Volatility Index for the CBOE, it fell to its lowest level since the beginning of the pandemic. Okay, so we got low VIX, low volatility, all-time highs in the Dow and the S&P. And yet we got inflation running through the roof. We got a lot of liquidity out there. And there's other risk and potential contagion risk that I've talked to our members about over in China with the debt problem and slowing earnings growth, although they're still coming in very strong. So why are the markets continuing to just scream bloody murder higher? Okay. Well, it's all about earnings, folks. Earnings are very strong right now. In fact, we're going to see Q3 earnings coming in generally around 33% above year-over-year comps. Now, last year, granted, the comps were lower than they were the year before because of COVID. But again, trading the financial markets is all about expectations. That's what it is. And as long as you're beating expectations, markets are going to do fine. Keep in mind that the Q2 pace of earnings growth was over 89%. So that was the third fastest growth rate since 2010. Typically, these huge growth rates come in off of a bear market low, as we saw in March 23rd was the actual low in 2020 last year with the COVID crisis. So we're seeing a lot of that just come in. You can see the trailing PE ratio at 34.5, but the forward is 22.17, so it's lower by 27%. So earnings are slowing down from the trailing 12-month based on current price action. Dividend yield 1.32%. 10-year Treasury came in this week a little bit higher, 1.66%. You can see the earnings yield for the S&P is stuck right around 4.5%. So that's 2.84% higher than the 10-year yield. So money is still kind of being channeled into the equity market. Okay. And as I said, the VIX closed out the week at it came in a little bit lower this week. It was down a little bit. So that's kind of where we're sitting right now with the markets. Okay. Now, if we look at the economic data this past week, home prices are up 19.5%. That's always helping with inflation. But the economic data was basically mixed. Okay. We did see housing starts and building permits come in well below expectations earlier in the week. Although existing home sales jumped, industrial production fell 1.3%, but we did get some lower weekly and continuing jobless claims, so that's on a good note, okay? And then, of course, if we look at the Treasury market, they were up most of the week. They closed out the week around 1.69% Friday morning, up from about 1.59% the last week. So up about 10 basis points. Okay, we're around a 5-month high in the 10-year Treasury. You know, and monetary policy is strongly in focus. All right, that's kind of where we're looking at this stuff. The Fed Fund Futures is forecasting about a 70% chance of a rate hike by the middle of 2022. Okay, so that they're moving it up, the Fed funds. So that's kind of how we're pricing this thing out. Now, of course, if we look at the markets and index performance, as I said, the Dow and the S&P made new all-time highs this week. Everybody was in the green for the week, from the Dow, S&P, NASDAQ, and the Russell. Okay, year to date, all in double digits, with the S&P leading the way at 21%. Sector performance, you can see for the week, real estate was good. Communication services 2 weeks in a row, basically flat to slightly in the red. Annual performance for the sector, energy was the best. Okay. So it was about 58% annual, and Staples coming in the rear, but still in the green at 7.62%. Okay. Now, if we look across Europe, you're going to see here in Europe, we kind of a mixed bag. The stocks was barely up 14 basis points. The FTSE was underwater by 41 basis points. CAC 40 in the green by 9 basis points, and the DAX, the German index, underwater by 28 basis points. So essentially flatline. Year to date, they're all in double digits, with the CAC 40 leading the way at 21.3. It's kind of one of the larger returns for the year for a larger country economy, just slightly ahead of the S&P's 21%. Okay, shares are up across Europe generally on strong corporate earnings, like here in the U.S. Now, members, we're going to go into detailed earnings this Sunday evening and just kind of what we can expect and which sectors thus far are doing better than others, and what kind of forward guidance we're seeing here. Meanwhile, over in the UK, inflation is it came in just a little bit, but still over 3.1% year over year. Okay, so that's well above the Bank of England's 2% target. And in the Eurozone, business activity slowed for a third consecutive month in October, primarily because they've got supply chain issues, ongoing COVID activity, shutting down, disruptions, things like that. The Eurozone composite output fell from 54.3 or it fell to 54.3 from 56.2. So it is still above 50, which is the demarcation line between expansion and contraction. Okay, so we're seeing things are finally starting to bottom pretty much across Europe. And then, of course, if we look at the Asian markets, you can see across Asia, we did get the Nikkei in the red, 91 basis points for the week, up, just slightly under 5% year to date. China and Hang Seng in the green for the week. Year to date, the only index, really major index in the red, is Hang Seng or Hong Kong. Now in China, their export growth decelerated in September, falling to about 13% year over year. Okay. On the other hand, their imports rose 8 consecutive months. So the consumers there are still buying stuff, right? Growth is kind of driven over there by strong demand for oil, coal, and medicine. Because remember, Japan imports all their oil, and with the price of oil going up, it's no surprise that their imports are going higher too, okay, to fuel that country. Meanwhile, separate data show that their CPI rose 10 basis points year over year. Now, that's a sign of rising energy, and while it's compared to other countries pretty much flat, for Japan, that's still, pretty strong. But it was the first rise in their CPI since going back to the early stages of COVID in March of 2020. So that shows you with Japan, they're trying to get inflation into that country, and they're having a hard time. And then meanwhile, further to the northwest in China, their stocks got off to a weak start this week when their country's GDP came in lower than expected at 4.9% for Q3. That's their first pass. Now we'll get our first pass this week. But the first pass for China, 4.9%, again, due to power shortages, sector problems, real estate problems, debt problems. That's their latest quarterly growth number is the weakest they've seen since Q3 of 2020. Okay. And their Q2 pace of this year came in at 7.9. So it shows their entire economy slowing down. Meanwhile, all their credit agencies continue to downgrade ratings on some of the big developers like Fantasia, Evergrande, and others, fearing a liquidity crunch on their property sectors and so forth. So we're getting some slowdowns in China. Now, some of that I think could spread over to our shores, but a lot of it in the real estate sector will not. It's fairly well contained, unlike what happened here in the U.S. in 08 and 09, where a lot of our real estate woes and debt and financial credit crunch affected everybody. Over in China, not so. They've got that fairly well contained. If we come over and we just take a look at our charts here for a minute, I'm going to show you the E-mini S&P 500 futures. What you're going to see here, I'll just give it a second to come up. You're going to see the chart the E-mini S&P 500 futures, as I said. And on the screen, you can see how we've got kind of a 3, 4, 5 Elliott wave pattern here. You can see I've calculated some pullback points based on, now this is on Elliott wave, a potential pullback point here down anywhere from 44.35 to about 43.94. So let's call it around the 4,400 area would be a normal pullback. Now the 50 EMA is sitting around 44.16. I would not be surprised to see a little pullback. However, remember what I've been saying, guys, for about 90 days now, since late summer. I've been calling for a pullback, actually most of the summer, to be frank, for anywhere from 10 to 15%. Now, as we rolled on through August, I changed our pullback depth of the pullback to 5 to 10%. Now, in the S&P, we ended up a little over 6.2% or so in the futures market, a little bit less in the cash index, SPX. On NASDAQ, a little bit more than that. On NASDAQ futures, a little over 8%. But we never got that big 10 to 15% pullback. And one of the primary reasons why is we just got a ton of liquidity in the markets, okay? Now what I'm saying is a little bit of dips along the way, but I think we can finish the year over 4,600, possibly even coming up to 4,700 before the end of the year. I think we're going to get a little bit more chop going into 2022. I think as earnings truly dramatically start to slow down in 2022 and they start the tapering, and the Feds are now on this quantitative tapering or quantitative tightening track, you're going to see interest rates, especially on the back end of the yield curve, the 30-year and so forth, going higher. We're going to see that happen, right? So we're going to see the yield curve. We got to watch that very closely. If it tightens and starts to flatten, there'll be more fear coming into the market. As long as it's rising, the yield curve, that's typically the 2s over 10s, which would be comparing the 2-year to the 10-year. And also understand that the 2-year is more sensitive to Federal Reserve pronouncements than the 30-year. The 30-year is driven more by inflation and growth expectations than anything else. So this is what we're looking at on the S&P E-mini. Now, if we come over, and this one, by the way, made new all-time highs on Friday, the 22nd, 45, 51, 50. And then, of course, if we look at the Dow, same thing. If we look at the Dow, new all-time highs on Friday of 35, 645. Pullback area in the Dow, kind of sandwiching the 50 EMA as well, same as the S&P 500, okay? Now, if we look at the NASDAQ 100, nowhere near making all-time highs, right? The last all-time high was early September, and then we had that pullback. Notice we did clear the 50 EMA. That will be the support. This zone here will be the support element for NASDAQ here. I do believe we're going to go higher. We may get a little bit of a dip. We may get some momentum in next week, early in the week, but I do believe we're going to go higher before we go much lower, all right? And that's going to be reflected going into 2022, okay? So the Dow and the S&P new all-time highs, nowhere close in the NASDAQ. And then, of course, if we look at the Russell, it's even worse. Last all-time high in the Russell was back in March 15th of this year. You can see that was the last all-time high right over here on that date right there, which was on March 15th, 2021. Every time we get up near the top element here, you probably want to be a seller of the Russell. And down here at the bottom, you want to be a buyer. So it's a wide range, but we've just gone nowhere. This is a really good swing trading kind of play here because it's playing these boundaries very nicely. Now, eventually it's going to break the boundary, but you don't assume a break until it actually breaks. Right now, if we come up, make new all-time highs, I think it's going to go for a run. Right now, that's not what the chart is showing. It's just showing we're still stuck here towards the upper end of the boundary. And that's about it for that, okay? And if we look at the VIX, you can see we closed out the week at 1543. We're fairly low. We're where we've been before it's really kicked up, right? You can see back over here in late summer, June 28th, and then we just started getting choppier and we were making higher highs and higher lows. And then we took out these higher lows and we actually came back down towards the bottom of this yellow zone, but we have not been in the green zone since before the pandemic. Green zone generally below 14, roughly, in the VIX. We're in that section here that I call choppy markets, okay? And you can almost see by the VIX right here just how choppy it is. We get down to the lower end of this choppy market price zone for the VIX, and then we tend to get these spikes higher, okay? So right now we're in a choppy market time, and I think it's going to stay that way. I don't think we're going to get below 14 before the end of the year. I think all we need is a couple of spikes to the downside, and you'll see the VIX very sensitive now, running right back up into the low 20s. That seems to be home for the VIX when we get a spike. We haven't had anything ugly. Really, when we started to pull back on the September the 20th, we did have the VIX spike up here all the way up to about 28, almost 29 intraday, and then it came back down, and then we've just had spikiness as we rolled back over again, okay? If we look at the front month vol skew, we're solidly, not solidly, but we're barely, and this is real interesting. Keep in mind that this thing is expiring, so it'll finish right around zero. So the new front month vol skew is going to be the this one down here roughly, and you can see we're well into the green. So we got a normal contango environment roughly, and I think we'll stay that way for a bit. So the markets really at this point are just not concerned, not worried at all. And if we look at the bond market, and I think I gave you guys this little trading tip too in picking up TLT over here. Puts in TLT back in the summer months, and you can see it's rolled off the table. I said go out longer duration. So as I was telling our members, you want to go out probably March of next year. Puts, bear put spreads, these kind of things, and you'll be well rewarded. And that's kind of where we're going here with the bond market, okay? It's just going to have higher interest rates, guys. And if we come over here and look at the 10-year interest rate, you can see here, same thing, we're moving higher. In fact, my target for the 10-year is, and it goes out to early next year, is around 1.9, right? We're sitting at 1.65 now. Would not be surprised once they actually announce and start doing the tapering, quantitative tightening, that we go over and take out the highs for this year of interest rates at 1.76, and we just run right up in this area here. So keep in mind, when we do have a fast run in interest rates, we tend to see the tech sector sell off a little bit, okay? So if you've got profits in some tech stocks, then either hedge them or just be very careful. Now, this next week, from an earnings perspective, members, I'll go through it with you in a lot more detail. But we're going to get, after markets close this Monday, we're going to get Facebook. And then Tuesday, we're going to get Google and Microsoft. And then Thursday, we're going to get Amazon and Apple. So we got Facebook, Google, Microsoft, Amazon, and Apple this week. Some really big earnings, all right? And then we're going to get the first pass of Q3 GDP on Thursday morning. So it's going to be a very active week, guys. And it could be either a really good week or just get really crappy data and get bad, have a bad week. Now, that's juxtaposed behind corporate earnings that we're getting over an 85% beat rate. Really, everybody's beating earnings, and they're beating them handedly. And again, it's an expectation game. And as I tell our members all the time, the markets are not the economy, and the economy is not the markets, okay? The markets typically trade where it believes the economy is going to be anywhere from 3 months to 6 months out in time, right? Generally, you could be moving up when you're in a recession and you don't even know it. And the markets could be coming out of a really strong downward move, which is forecasting a recession out in time, right? Because everybody likes to front run trades. That's a little bit about why that statement holds true of the economy and the markets. If we look here at the treasuries, I think once it starts getting over 1.8, 1.9, and then 2%, you're going to see it starting to affect, using discounted cash flow models, the PE ratios of all the stocks. You're going to see revaluation of pretty much all the companies in the Dow and the S&P and NASDAQ. And that's going to cause a downward revision in earnings growth, and that's going to put a crimp in profit margins with higher interest rates and inflation and so forth. And I just think you're going to see the markets back off a bit. Not right now. Again, if we get any pullback now, it'll be worth buying because I think we're going to run higher through this seasonally adjusted strong time of the year for the markets. After that, I think all bets are off. Okay. If we come over and look at gold, we're playing long-term gold to the upside. We had an intraday reversal in gold. It did finish up, but it was up 30 points. It pulled back about 20 points intraday. But I still think longer-term gold is going to be higher. Okay. Copper, we're still playing this to the upside. I think I gave you guys another tip on you want to be long copper over the next year or two. I think copper's got at least a 20% growth rate over the next year. EVs, electric vehicles, use 40% more battery, copper than say gas powered, and they're going to be mining more and trying to bring more copper out of the ground. You can't just open a copper mine, right? It takes a while. The lag is strong, so you're going to see some upward pressure on copper. All of this right now is copper is just trying to work out profit taking and trading. But I think eventually when we break this 4.88 level, it's gonna go higher. Okay, so that's just another area that we're playing too. And if we look at oil, well, we had adjusted our stance on oil. You can see that really tight regression channel there. I think oil is going to run up a little bit more, but again, and it's a 3-leg up. So I'm looking at oil actually running up into the 90s, and I just don't see anything standing in the way of stopping it near term. Longer term, I think OPEC will step in. But near term, I think the momentum's going to carry it higher. And there are a number of ways to play this. And members, we're going to be looking at some additional ways to play the oil market profitably. But if we look at it, again, any pullback should be bought in the oil market. Now, Nat Gas is another one that I was talking about. And I told you guys here in this free roundup on the weekend, at these levels here, you need to fade the move. And that's what it's done. It was a good trade. A number of our members took the trade when I was talking about it and just doing some tight bear put spreads in the Nat Gas market. Pullback caught itself right on the 50 EMA like it did here, like it did over here. So the 50 EMA has been serving as a nice level of support. I think it's going to run up a little bit more. If we have a cold winter, it's going to go well over 7. And then we're going to lick our chops and be even more eager to want to short this thing because Nat Gas should not be up this high. But we're getting demand and supply issues, supply chain issues in Nat Gas. So, and that's going to, there's another trade. Members, I'm going to talk to you guys about Sunday, a stock that's a good way to play Nat Gas, I think, and you collect dividends on it at the same time. So we'll take a look at that this weekend. All right, everybody, that's where the markets are looking right now. So net, we can expect a little bit of a pullback over the next 30 days, a little bit of volatility. But as we go into the end of the year, I think the S&P and the momentum is going to carry us to new all-time highs, well over 46, possibly even 4,700. We'll see how this thing shapes out, but that's what I'm looking at based on the earnings forecast right now. All right, everybody, have a great weekend. Enjoy the college football season. Members, I'll see you this Sunday evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao now.